Hi friends, this episode we will see about the financial plan building blocks. There are 5 building blocks in the financial plan. So we will see about one by one. So first is cash flow in your retirement monthly pension during retirement. Then investment planning, aggressive or conservative. Then the third building block is real estate analysis. Fourth building block is income tax planning. And fifth is legacy for family using estate planning or trust, forming the trust. So when you are doing any planning for your family, right, you should consider all these building blocks. As a good financial professional, we need to plan for all the 5 building blocks for your family. So retirement it will happen to anyone actually. You will get aged. That time you need a monthly cash flow coming to your bank account. So that is your retirement planning. In the retirement time, assets are not more important. How much you are going to get the monthly income is going to determine your lifestyle. So when you are planning in the financial plan, your cash flows in retirement is really important. So next is investment planning. In the investment planning, there are aggressive or conservative type. So you need to make sure how you are going to be aggressive or conservative in your investment approach. So when you are, for example, if you take your child goals, the child age is age 1 only. So time is on your side. The time is the greatest asset. So you can take aggressive calls in the equity investments based on the market conditions. So suppose the child is in 10 years means he needs to go to the college at age of 18. So we can't be aggressive. So we should be less conservative in the approach. So the time plays a vital role in any investment planning. Whenever you are very young age, you should plan the investment process yearly itself. So when you are getting old, then only you are starting the investments. We can't be aggressive in that time frame also. Based on that market conditions also, you can be aggressive, but the market condition is not ready for the aggressive investments means you lose money. So the time and also plays a vital role here. Then the real estate analysis. Many of them have 2 to 3 properties in their kitty. So they need to analyze the real estate analysis. So how the real estate is performing, whether it's active or passive, how they have invested in the real estate, whether it's yielding the right results based on the estate. They need to do they reevaluate that thing actually. When they made the investments, they need to reevaluate actually. So how the real estate is performing now, like that they need to reevaluate. Because the real estate prices also crash. It can come down, it can move up also based on the economic situations. It is not immune to the economic situations. So real estate analysis is also needed for your financial plan. Then the income tax planning. So in case of income tax planning, so whenever you make investments, you need to consider the income tax implications also. So how you are going to be taxed for that investments. It is not about the current investments, how your family is going to get that asset. For example, if you say you are invested in the property or the plots. So when you pass that properties or assets to your kid, so then it will be taxed. Because the real estate, this is a long-term, short-term gain is there. So when you are after 2 years, you are selling it, that asset, it will come under the long-term investment gain. So when you are passing the assets, how each asset is taxed. When you are passing the FD or mutual funds, stocks, how it is going to impact your taxation of your future generation also, how is going to impact you also. You should consider that income tax planning also whenever you make the investments and passing to the generations. So you need to be utilizing your income tax laws effectively. So then comes the legacy for family. So it is not necessary only the legacy for family is applicable to only rich people or ultra net worth high people like that. So whenever you have some assets, even some rupee aligning 1 lakh or 2 lakhs or any other assets, you bought a home like that you need estate planning also. So estate planning is how you want to distribute your assets as per your will actually. As per your will, how you want to estate. Suppose you have 2 kids, son, daughter, or both are sons, how you want to distribute the assets to them actually. So how much you want to be asserted, how much pension you want to give it to them when you are alive, how much you are ready to give the pension to them also, or how much they get it from each of these your investments. So you can determine that. If you are not planning for your estate planning, then it will go by the law. Everything will go by the law. It's not per wish actually. So as a part of that, you need to plan for the estate planning and trust also. Some of them will form the private trust also. So that also needed. So whenever these are the building blocks, financial plan building blocks. So your advisor also need to work with the income tax chartered accountant, and with the lawyers, attorneys. They should also work with these who are the specialists in their areas also. Some of them may be specialized in income tax. So some of them is specialized in this estate planning and trust. So you need to work with the specialists. Like doctors, they have a specialist in rheumatology, pediatrician. So everything we have a specialist in the doctor's profession also. So they are the specialist in some of these professions. So financial advisors will work along with their further lawyers. Then they will work with these CAs for the effective tax planning also. So we should consider every part. It's not only the financial advisor. We should be consider all your part of the journey also. So this will give you a smooth transition to your wealth to the next generation. How effectively you pass, how you effectively using the income tax laws, then how you are effectively using your real estate or income investment planning, and how much you are going to get in the retirement. See, market will be very dynamic. So how much you are going to take risk in the retirement, when you are aged, your risk appetite will come down actually, because your assets, whatever you created, it should yield you the monthly income. So markets can go up and down, or it will be range bound for many years also. So you should have the cash flow planning properly during your retirement. Now itself you should plan properly in your retirement also. Thanks for watching.